wealth builders. You're listening to Wealth Building with Options. Here's your host, Dan Passarelli.
Welcome, wealth building family. In this episode, we're going to talk about incredible topics. There will be controversy, plenty of tension and release. We'll briefly discuss the cure for cancer and crooked accountants. And we'll talk about a key fundamental difference between the stock market and the options market and how they intermingle to create something greater than the sum of their parts. And we will discover together how wealth is created in the stock market. Today, ladies and gentlemen, we have all this and more in store for you. So put on your seatbelt because here we go. Okay, maybe I oversold that a little bit, but I'm not lying. We really will talk about all that. But hey, anyway, it'll be a really good show. So, as far as controversy goes, I typically like to avoid controversy. And it's not that I'm afraid to be controversial. It's just that, it gets in the way of the message sometimes. Some podcasters and writers don't avoid it. I mean, some milk the controversy. You'll come across these podcasts or Substacks or whatever with, the extreme political slant traders, or the ones with extreme financial or investment ideas and the fear mongering that goes along with it, right? Or maybe the weird science guys who believe the earth is flat and how that affects their investing or whatever. I don't know. That's fine for them. It's just not my jam. And I especially don't like controversy when I don't intend it. Here is where I probably made up my mind to not be controversial. So this is probably like 5 or 6 years ago. I was giving a free workshop to traders in a trader group in the San Francisco Bay Area. And to be fair, they were a pretty smart group, though there were a good handful of members of the group who thought they were smarter than they actually were. There were a few real jerks in the leadership there, but hey, I digress. Let's forget about that. So I was thinking about this time when I was talking to them, and I was talking about how traders think, which is a really important topic. And so I thought to make my point, I would delve into the subject of game theory. Game theory is like a series of thought models, I guess, puzzles to get the thinker to arrive at the most logical solution. And there's a lot of like prefabricated ones out there that are, just fun to play around with. A lot of times there's like some math involved or whatever. You get the idea, right? So the game theory game, or whatever you want to call it, I introduced that day was called the Monty Hall dilemma. Now, honestly, I am a little bit loath to even bring this up, the Monty Hall dilemma. I was a little scarred for life after this experience. So the Monty Hall dilemma is a puzzle that has a counterintuitive but mathematically correct answer. So during my workshop out there, I playfully posed the puzzle. So, in fact, what I'll do here for you is pose the puzzle, but I'll let you look up the answer later to let myself off the hook from making the case for it here on this podcast. So sorry in advance for my cowardice, but yeah, like I said, I'm scarred for life, right? So the Monty Hall dilemma goes kind of like this. You're on a game show, and there are 3 doors. Monty Hall, the game show host, explains that behind one of the doors, there's a brand new car. And behind each of the other 2 doors, there is a goat. So then he asks you to choose a door. So you do. You choose one of the doors, hoping for the car, and we're presuming you're not like a goat person and you'd prefer a goat over a car. So you're trying to get the car. Next, Monty Hall says something like, "Are you sure?" And you say, "Yes, I'm sure." Then he says like, "Well, let me show you what's behind this other door." And he opens one of the doors that you did not pick, and he reveals one of the goats. Then he says, would you like to change your mind and pick a different door? So there is a right answer to this. After this podcast, go to my Substack and you can read the article that I wrote on the Monty Hall dilemma and how it might relate to your investing. That Substack, by the way, if you are not a member yet, is Wealth Building with Options, all one word, wealthbuildingwithoptions.substack.com. There's a link in the show notes. And while you're there, please subscribe. If you become a paid subscriber, you actually get some special video bonus podcast episodes, as well as some other really great goodies. Subscribing helps me pay for all the support and tech stack that I need to make this podcast possible. And for you, what you get, it's really well worth the investment. So anyway, I reveal the mathematically correct answer in my workshop. And recall, the answer is actually a little counterintuitive, and a couple of the know-it-alls there take it upon themselves to engage in arguing with me about it. If there's one thing I learned early on, in fact, I actually learned this on the trading floor, but that's a story for another day. If there's one thing I learned early on, it's that you can't argue with an irrational person. And when the actual logic to this puzzle, this game theory puzzle, is a little bit mind-bending to begin with, well, you're just in trouble. You're in a pickle, as it were. So, yeah, that's why I typically avoid controversy going forward. But we come to the part of the show where we must engage in just that, a controversy, because I think I'll be able to make my case with this one a little easier than talking the Monty Hall dilemma. Though, to be fair, I have had people argue with me about this one too, but hey, that just forced me to think through the logic progression better so that I got better at explaining the logic behind it and, behind the point of it. So here we go. Here's my statement. Options are not a zero-sum game. Okay, first, what do I mean by that? What is a zero-sum game? Well, a zero-sum game is one in which for every winner, there's an equal and opposite loser. If one trader makes $100, another one must lose $100. If one makes $9,950, the other must lose $9,950 or whatever I said. So let me repeat, the options market is not a zero-sum game. Now, before I justify that statement, there's kind of a lot of antecedent that goes here. Let's start at the beginning of this logic progression and start with the stock market first, which is certainly not a zero-sum game. So a stock is literally a share of ownership in a company. That's why they call it a share of stock. You are literally sharing in the ownership of some sort of company. Now, high level, just, forest view here. Corporations that you can buy shares in, publicly traded corporations, they create things of value and sell them, and the owners, which are the people who own the shares, get to share in the profits. If a publicly traded corporation suddenly discovers how to build a better mousetrap, or make a more delicious cheeseburger at half the cost, or discover a cure for cancer, something the public or portion of the public finds valuable, well, theoretically, the company can just suddenly be worth more. But this sort of thing doesn't always build value for the company. The company is a business, and the business has to be run well, too. Somebody said, I forget who it was, a business is a machine. It was some industrialist or someone. Some machines are built better than others, and some don't work at all or are broken. In some ways, the quality of that machine or how well the business is run is more important than the quality of the product produced. The company itself has to be valuable. It has to create a revenue stream for its owners, and a real revenue stream, which is created by the management team, the stewards running the company. If the CFO isn't doing things right, he's cooking the books or something, well, that's not real value. I'm talking having a product that is marketed and sold successfully, and a revenue stream is created for the owners. The owners may opt to get dividends or may opt to have that revenue that they get reinvested into the company because the management team can use that capital to produce even more revenue. This is wealth being created. When a company becomes a publicly traded corporation, they first have some private rounds of funding, and then they have an IPO, an initial public offering, which is the first initial time the public is offered shares. Initial public offering, IPO. The investors in the IPO presumably do their due diligence and figure out what they think the value of the company is, divide by the number of shares, and will pay that much or less per share. So the value has been created at that point. The company's been around for a while before it goes public. Talented business people create a machine that generates profits or is expected to generate future profits. Would you like to buy a machine that prints money? Wouldn't that be valuable to you? So then once an IPO has taken place, the shares trade in what we call the secondary market. That means people who own the shares may not want them anymore, so they sell them to someone else. It's trading. This is the stock market you probably think about when you think of the phrase stock market. But wait, isn't that a zero-sum game? One person sells a stock at $100 to another person, and the stock goes up to 110. Doesn't that mean one person made $10 and the other one lost $10? No. The person who sold it may be taking a profit or a loss from where he or she bought it originally. But that's a point that could theoretically be argued too, right? So the real reason that shares of stock are not a zero-sum game is because the company, or maybe more specifically, the company's talent, their talented individuals, could do something that makes the company more valuable, independent of any shares changing hands. What if they've been working on that elusive proverbial cure for cancer and finally cracked the code? Boom, there's instant value created, an increase in wealth. And the shares are already in existence. They are already owned. If someone sold them, they simply rid themselves of the opportunity to participate in additional wealth. Now, you may ask, well, what about the people or the firms who shorted the stock? Sure, their losses are offset by the gains of the person they sold it to. In that isolated transaction, one wins and one loses, but first it's typically a small percentage of the float or the shares available for trading that are shorted. And regardless, again, these shares exist and the value of the body of the shares that exists still increased, right? So it is not a zero-sum game. Now, options at first glance seem to be kind of a zero-sum game. And at face value, that can be a little bit justifiable at this point until we get into the nitty-gritty here. Because options are contracts, all right? It is literally a contract between two people. That's why we call them contracts, because it literally is. One person owns the right to buy or sell a stock, depending on if it's a call or a put, respectively, from another person who has the potential obligation to sell or buy that stock from that other party of the contract. It's a little bit of an oversimplification there, but that's basically how it works. So let's say someone owns a call option. The call option is the one where the owner has the right to buy the stock at the strike price from the counterparty, right? So if the underlying stock goes up, the person who is long the call, who is the owner in that contract, makes money, and the person who is short the call loses money. Okay. Well, that kind of sounds like a zero-sum game, doesn't it? What about if the option expires? So somebody buys this call from a person who sells this call, and the option expires worthless. If the option expires worthless, that means it reaches its expiration date and just kind of disappears and is worth zero. So that means the person who bought it lost 100%, and the person who sold it made that same equal and opposite amount. Okay, geez, that still kind of sounds a smidge like a zero-sum game here, doesn't it? And there's a lot to explore here. Like, what if it's a little bit more complex, right? Like, what if somebody legged into a spread? The one option and the other option are not held by the same counterparty as the person who has them both, as long one and short one. But, if you think about it, that doesn't really matter. It's still in aggregate at this point. That kind of seems like a zero-sum game if you just look at them individually, right? Okay, what about if someone exercises their option and it becomes the underlying stock, right? Long or short, depending on if it's call or put. Well, then, let's just take that person who bought the call, right, from the other party. We'll just keep it like that for a second. That's a little bit of an oversimplification, but work with me. So the person who bought the call decides to exercise it. So then that person is now long the shares of stock at the strike price. Whatever that person paid for that call is now gone. Now they have the stock at the strike price. But the counterparty, person on the other side, whatever they collected for that call is profit. So that person made whatever the long one lost. But now they're short the stock at the strike price. And so if it goes up a buck or down a buck, they both still lose and make the same amount. Okay. So it's a little fudged. Still, think about it as intrinsic value and, okay, still kind of feels like a zero-sum game. All right. Now, what if one party had a position in the stock already, and it's being offset by an option position, like a covered call, for example, or could be a number of different things. Okay, so now we're starting to get somewhere in this progression of logic. The fact that options can be exercised and thus used to create a hedge, a position in the underlying, makes exercise an important part of this story. The fact that options can become the stock makes the two markets, stock market and options market, forever intertwined. They're part of each other, or at least I should say the stock market is necessarily part of the options market. More specifically, the underlying stock of a particular options class is forever intertwined with the options that are listed on it. Here we need to digress for a minute and talk about the difference between listed options and warrants. So a warrant, let's start with warrant. They kind of came before listed options. A warrant is basically a call option that the company creates for their employees as part of maybe a compensation package or other financial reason. They might give warrants to employees or sell warrants that enable the holder of those warrants to buy shares of stock at a certain price. So there, the companies are issuing those, and actually those options kind of will affect the value of the stock itself fundamentally a little bit. Listed options. Okay. These are not listed by the company. These are listed by an exchange. The company doesn't have any say-so in it. The Chicago Board Options Exchange or whoever, New York Stock Exchange, can just one day say, we're listing options on this company, and they don't have to ask the company or anything. They just do it. Now, another thing with listed options is that they're fungible, they're traded on different exchanges. You can buy it on this exchange and sell it on this exchange, and there's a central clearinghouse. And so whoever's the counterparty that you make the trade with they might trade out of the position and close it and toss it over to somebody else. So there's not always an exact opposite party. All right. Now, all this being said, to be clear, listed options are not necessarily part of a stock's wealth creation. No, could make an argument for that as well. But the underlying stock is indeed part of the options that are listed on its wealth creation, right? A way to think about it is the option can become stock, but the stock cannot become an option. So here's the real rub. Because of all this, options end up not a zero-sum game. And a lot of it has to do, like the best way to think about it, to me, is to think about the role of liquidity providers and hedging. So there is a role in the options industry, a specific type of trader called a market maker. Now, this is what I used to do a long time ago. I was a market maker on the Chicago Board Options Exchange. What market makers do is they make a market. They give their bid and their offer, and they say, what do you want to do? You want to sell to me on my bid? You want to buy from me on my offer? Doesn't matter. And they accumulate these positions. So because they're not like studying the stock and making the decision to buy an option here or a spread here or something, what they have to do is they have to hedge every option position. They do that by buying and selling shares of stock to offset the directional exposure of the option position. And then they're just left with the other optionality, time decay and volatility and interest rates and such. You know, they try and make those flat as well. The way to think about hedging is the market maker who is hedging the option position, they hedge in a way to become what's called delta neutral, which is the best way to think about that is how much does the option act like a stock? Like if I own 10 of these calls and it's a 70 delta, it's going to feel like I'm long 700 shares. Like I will make or lose on that option position, just like I would make or lose on 700 shares of stock. Okay. And I don't want to get too heady with option Greeks and all that right now. You know, we're just starting out this podcast. So I bring this up though, because the hedge can be thought of as shares of stock. And that many shares of stock need to be brought into the equation. And these market makers, what they need to do is, because the delta changes, when the stock goes up or down, they need to re-hedge. Okay, it's called re-hedging, where they might have to buy or sell more shares of stock if it goes up and buy or sell more shares of stock if it goes down. And that's a very common thing for market makers to do. They have to do that. But position traders, us market takers, well, we don't do that. We don't dynamically hedge and, re-hedge all throughout the day or anything like market makers have to do. And so therein lies the perfect example of how both parties can win, both parties can lose, or a mixed bag, but definitely not a zero-sum game. Let's take an example. Let's say that there's an investor who owns 1,000 shares of a $100 stock. Okay. Well, this investor might choose to roll that into a covered call and sell 10 covered calls. Because remember, each call represents the rights on 100 shares, right? So I'd have to sell 10 to cover 1,000 shares. So the investor just goes into his or her brokerage account, sells 10 of these calls to a market maker. So now the market maker is now long 10 calls. The investor is short 10 calls. But that's not the whole story, because the investor also owns 1,000 shares of the stock, so has basically 10 covered calls on, right? And the market maker, as soon as he or she buys those 10 calls, they need to short some stock to offset the delta of those calls so that they're delta neutral, so that they have no directional sensitivity. Now, they don't short 1,000 shares. They would only do that if these calls were extremely deep in the money. They might have to short like 500 shares or more, probably more like 400 shares or something like that. So they short 400 shares. So the investors long 1,000 shares against the 10 short calls. The market makers short 400 shares against the long 10 calls. But then let's say the stock goes up a little bit. Oh, now the market maker has to short a few more shares. And then the next day it goes down some. And then the market maker has to buy those shares back to rehedge. And maybe it just kind of oscillates a little bit. It goes up and down, never going up through the call strike. But the market maker is forced to rehedge. And when market makers are long options, like this one is in this example, that sort of volatility works out great. What they end up doing is buying when it's cheaper and selling when it's more expensive. That's called positive gamma. That's one of the benefits of long options. And if they do enough of that to offset the time decay that they lose on those options every day, then they've got a pretty good thing going and they can end up making money on this. Now, let's look at the investor again, right? Well, if the stock never ended up going through this strike price, but maybe it's like a little higher at expiration, well, then those options, they'll expire worthless and the stock's higher. So that investor made money on the covered call. And the market maker also made money on the position that they were trading. They both win. So it's because that liquidity providers dynamically hedge and they do things different than what the investor is doing. It's basically two different parties using the options market for two different purposes. And they can both win. It's not a zero-sum game. Now, by the way, this is only official episode 2 here. So if some of the things that I'm saying here, covered calls and dynamic hedging and delta, if it's like, whoa, I don't know, this is like way too advanced, don't worry. We're going to go nice and slow throughout this whole season, and it'll all make sense to you by the time we're done. Okay, so this is how it works for, one individual trade like that. But what about just the market overall? Well, I mean, just steal the punchline here. The market overall is made up of a bunch of stocks. And so if it works for one, it works for all of them. But let's drill down here. We've been doing a lot of drilling down here today. So what really is the stock market? Well, I mean, the word market, it kind of originates from just back in the day, you'd go to the markets and buy some live chickens and, whatever celery or whatever you had to do. And, you bring it back home and cook it. And you have to shop every day, I guess, because you didn't have refrigerators. So it's just like a place where people get together to buy and sell things, right? And that's kind of what the stock market is too. It's just a little higher speed. Also, as far as market goes, market is the bids and the offers. That is, if you see a bid and an offer for an option, that is what we call the market for that option. But I mean, really, the stock market, it is really that original thing, the market type concept, where It's a place. It's kind of not really a physical place anymore. It's all sort of electrons these days, but it's a virtual place where stocks are traded. Now, again, when wealth is created for the owners of a company, it's created by the people running it. Information is shared in financial reports, earnings reports, and guidance that comes along with it on the conference calls, analyst recommendations, press releases, and even news articles. So financial reports for U.S. companies are released quarterly and annually. The quarterly ones are called a 10Q. These are unaudited, so they're probably right. But, we end up finding that out later, a little bit more officially, when we get the annual reports or the 10Ks, which are audited. So these are as accurate as it gets, but there are different acceptable ways to present information in financial statements. GAAP, GAAP must be followed. That is generally accepted accounting principles. There are some alternate ways to present information that is still GAAP, like you could choose to do your inventory this way, like LIFO and FIFO, it's all this stuff. So it does take a trained eye to really be able to read these financial statements very well. And the best information, it only comes out once a year. Stocks are traded by the millisecond, but corporate information is updated like by the year, by the quarter. So quarterly earnings and the conference call that follows it comes out once a quarter. It's usually in what we call earnings season, but not all companies report during what we call earnings season. So that's pretty limited information. They do tell you exactly what their profits were and revenues. And then they tell you, hey, this is why we did so great, or this is why we did so poorly, and this is what we expect next year. They do that in the conference call. So the conference call ends up being a little subjective-ish as far as the information goes, but it's information. Analyst recommendations. Okay. So a lot of people trade off and make investment decisions based on analyst recommendations. Now, each analyst, that's one person's view, arguably one really smart person's view. So people tend to look at many analysts' recommendations. Press releases by companies, they're usually pretty short bits of information that don't say a lot and can leave a lot open for interpretation. News articles are by journalists, and that can be very subjective and can be inaccurate, misleading, or just plain wrong sometimes. So why am I telling you all this? It's really difficult for an investor to get and interpret solid info and make great decisions. It's delayed. We're relying on others. We have inability to accurately assess the numbers and what executives say in a lot of cases. It's a job in and of itself. It is a skill in and of itself, and very few people have the ability to do a good job by parsing that information. Diversification is one of the things that solves this problem. If instead of just investing in one stock, we invest in many, well, that kind of can smooth out some of the shortcomings from analyzing just one stock. And some of the shortcomings from making a mistake and being wrong on this one, maybe you make a mistake and you did better on this one than you thought you were going to. The rule of thumb is based on the idea that you need 30 data points to get enough information to make a statistically sound decision on, the average of that population. So what we have in the stock market are indexes or indices. You can say it either way. Now, indexes have been around for a long time, long time. The first one was Charles Dow, who was the creator of the Dow Jones Railroad Average. And many, 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 many indexes have come into being since then. Now the Dow Jones Industrial Average is one of the biggest ones. The S&P 500 is arguably the index. People equate that to the market sometimes. And when you have a basket of stocks like this, an index, What you get is lower returns than you might be able to get with one individual stock. That's right, but a much lower standard deviation. It smooths everything out. So there's a little lower return and a lot less risk. Now, the stock market, as measured by the S&P 500, has tended to go up on average 10% a year, or 8% a year if we account for inflation. So what a lot of people do is what is called the buy and hold strategy. Now, the buy and hold strategy is, well, it's kind of self-explanatory and pretty darn simple. It's when an investor buys and holds shares of stock, ideally in different companies, to take advantage of that diversification. So let's zoom out for a second here. Over time, man has made more discoveries and created more inventions and tools for a better life. We started sitting around a fire, and now one day somebody figured out how to make an oven, and now we just pop a hot pocket in the microwave, right? We're not out there hunting for food or anything like that, right? So the index, especially the S&P 500, like this is one of those, okay? This is one of these great inventions because you're basically able to, and we're going to talk about ETFs in just a second here. You're basically able to buy one share and own a piece of 500 companies. We can participate in that 10% a year if we just buy the S&P 500 or something that replicates the S&P 500 and just hold on to it for, 20 years or something. But if you can do that, wouldn't it be better if you beat the S&P 500 to do even better than that? Well, here's another great invention. Options are an invention that has been shown to make that buy and hold investing better. In the prologue episode show notes, there's a link to some white papers and studies that prove that and show how it works. Covered calls, cash secured puts. These are ways to get higher returns out of that traditional buy and hold investment and a lower standard deviation, less risk. So now let's talk about really the whole kit and caboodle here. I mentioned ETF earlier. That's an exchange traded fund. So when did ETFs come into existence? 30 some years ago, I guess, I think. So an exchange traded fund, like there used to be mutual funds, right? I think there still are mutual funds, but I don't think anybody buys them anymore. And those, like there would be some fund manager who buys shares of some index, and maybe it is the S&P 500, and you could buy in there once a day just on the close, some of them, and that kind of thing. And they had big fees and all this. Well, ETFs solve that problem. And they basically trade all day long, just like a stock, with very, very, very minimal fees. So there is an ETF on the S&P 500. It is called the Spiders, or SPY. And what we can do with those is we can trade this whole basket with one instrument, right? This 500 shares of stock in one share of the SPY ETF. And then, what we can do, if we own 100 shares of that, we can sell a call on that ETF in one fell swoop. We don't have to buy 500 different companies and sell. We don't have to buy 500 different companies and sell options on 500 different companies. It's just one. We live in a world with incredible financial tools, and it's pretty darn cool. And that, ladies and gentlemen, I think is a great place to wrap up Trade Smart.
Options involve risk and are not suitable for all investors. Before buying or selling an option, read characteristics and risks of standardized options. A link is provided in the show notes. To learn more about your host, Dan Passarelli, please visit markettaker.com.